Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor, Mark Struthers, takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address not just the financial part of retirement, but also the social, the physical, and the emotional parts of retirement. Everything you need for healthier, a wealthier, and a happier retirement. Here is your host, Mark Struthers.
Hi, welcome to the Healthy and Wealthy Retirement. My name is Mark Struthers, and we're not in our usual studios because we film from two different places. We're at the Graduate by Hilton. I have a lot of Hilton points, so I stay at a lot of Hiltons, but these are a chain that are put on college campuses. So my son actually lives across from one in Minneapolis. We stayed at one in Madison during a visit. And I'm here at Berkeley because I'm at a 529 conference, a 529 Education Funding Account conference about a mile and a half from here. And as I walked around, now I was hoping to do some hiking, but a leg injury kept me from running or hiking, but I was still able to walk, thankfully. I'm walking through campus and seeing all the students and wondering, what role 529 played in them getting here. I'm sure scholarships played a role, but 529 plans are something that should be looked for anyone when it comes to education funding. They are a powerful account. This channel, and some of you might be saying, well, Mark, 529 plans are for 30-somethings. Why are you talking about this when your podcast is aimed at 50 and 60-somethings for retirement? And the reason being is that they are actually something that can be used for retirees as well. So these are a powerful tool, not just for gifting to to family members, but they also have other benefits. So there are four main benefits to retirees having a 529 plan. Tax advantages. So when you gift those funds to a 529 plan, they're no longer taxable to you. So that they're growing tax-free. Any sort of dividends have no impact on you. So these are a way of getting some assets out of your taxable purview. Now, if you do end up taking the funds as the owner and they're not used for a qualified education expense, you do pay tax on the earnings, ordinary income tax, and a 10% penalty. Now, that will scare some folks away, but really shouldn't. At least take a closer look because having that tax deferral is powerful. It's not to say that it shouldn't be your only account that you have in retirement, but this is something that there are advantages for you immediately as far as getting those assets out of the year-to-year IRS, assuming no distribution. There are also tax credits or deductions. It varies with each state. In Minnesota, they have a pretty nice one. And if your income is low enough, like it often is in retirement, you might be eligible for a credit, which reduces your tax liability dollar for dollar. Even the deduction can add some tax benefits. Also, number two, it's an estate planning tool. So these are considered completed gifts. They're kind of irrevocable. Usually when you have these completed gifts, you lose control of them. 529 plans are special. You actually maintain control as the owner, so you control the investments, you control the beneficiaries. So it's a pretty powerful account to be able to consider a completed gift, so it's not in the estate. Now, everyone gets a lifetime exemption amount. It's currently so high for most people. This really isn't an issue. It's $14 million per person. On the federal side, $28 million per couple. So that's not that. So for a lot of folks, that's not that big a deal. State by state, like in Minnesota, that generally follows the federal rules, but their limit is only $3 million per couple. So when you think, and that certainly a working professional family can certainly get up to, you don't have to be too high in the middle class to have a $3 million net worth. That's where, if you wanted to get some of these, Minnesota's a high tax state, to get some of these assets out of your state so your loved ones don't have to pay taxes on it, this could be a good tool. And it's another way of just looking down and saying, am I comfortable with that outcome? Is there anything I can do about it? Now keep in mind, it varies from state to state. This doesn't count inheritance tax, which is paid by the beneficiaries, not the estate. And year to year, each person can gift $19,000 with no gift tax. Now, technically, because that lifetime exemption is so amount, you can simply subtract it from the one-time lifetime exemption amount of $14 million. You do have to do some IRS paperwork, and it adds some complexity. That year-to-year $19,000 or $38,000 per couple per beneficiary is pretty powerful. So again, it makes it very easy to contribute to if you did want to get assets, one from year-to-year taxes, but also out of the estate and still have some control over it. If you can't change your beneficiaries, you can take the distribution and just pay taxes and the penalty. It might be worth it. So it's a great estate planning tool as well. And it's nice to have that account diversification. If you're going to be leaving folks IRAs that are taxable, that have forced distributions, even Roth have forced distributions that are not taxable. Most of the time, the taxable accounts will have to step up in basis. But these certainly can be a good, another tool to have. So the one thing I will say is that if you have any multiple accounts, does add complexity. So just keep that in mind, that this is one more thing for you to keep track of. But for a lot of folks, it might be worth it. Number 3, financial control and flexibility. So I already made reference to it. I jumped ahead. Very few things can you actually gift an asset, consider a completed gift, but still have control over it. That's why for a lot of wealthy people, these are a good thing, because it's not like gifting it to like an outlaw account or gifting it to a trust. You still have control over it. And number 4, it encourages education. If you establish education, even if it means a trade school or whatever it is, or just that education, lifelong education is important, this is something that it does do. And I'll circle back to number 2 and 3 again, is that this is something where you could pass down the heirs for generations to come. You could have the magic of compounding and high returns if invested aggressively, where you're doubling your money, probably at least every 10 years, every 7 to 10 years. You could really grow a huge nest egg that's passed on to generations, and it also encourages education. So those were our 4 key benefits. And we also have 5 things for implementing 529 plans in retirement. Number 1, just assess your situation. These aren't for everyone. Usually you need to make sure your core living expenses are taken care of. You need to have the blocking and tackling done. These are really kind of something extra unless it's very small. So you need to make sure this fits into your financial plan as far as what your goals are. You don't want to have to forego, maybe you do, but forego a trip or a car or certainly healthcare or long-term care in order to have a 529 plan for grandchildren, great-grandchildren, whatever it is. Depends on how big a priority it is. The biggest thing, you need to make sure you're making an informed decision. That's what financial planning is all about. Now, number 2, identify beneficiaries. Are these kids that are really going to use or appreciate it? Now, keep in mind, 529 plans could be used for a lot. And there's more flexibility as converting them to Roths and so forth. And that's probably going to get better and better. But make sure you have someone who is going to use these, depending on, how much you're given. Number 3, super funding. So we mentioned the annual gift tax exclusion amount of $19,000 that resets each year, where you're not touching your lifetime exemption amount, although most people are never going to go through that. It just saves you some tax paperwork. But you can super fund these, especially this is good for the wealthy, 5 years at once. So $95,000 per beneficiary per year, or $190,000 couple. So if you are very wealthy, or you really want to get these started, you can super fund them 5 years at once, get that without dipping into the lifetime exemption amount, the one-time lifetime exemption amount. This could be a really good way of getting that compounding in. 4, consult with a financial advisor or tax person. Just make sure this is a good fit for you. Make sure you're aware of the outcomes and people that are familiar with this. And number 5, monitor and adjust. Make sure that your investments match up with what the need for the funds. That's a big one with college funding, and make sure that the tax benefits are still there. This is still a good choice. If one of you goes into long-term care, it might be a case where you say, you know what, definitely we need to stop contributing, or maybe we need to take a distribution, or at least consider a plan for it and pay the taxes because we're going to long-term care. 529 plans for retirees are often overlooked. They can be a great thing for grandparents to do, not just to help out their loved ones, but it's also, there's a lot of tax benefits for them as well. If you put some thought into using 529 plans for retirement, you can have a healthier, a wealthier, and a happier retirement. Don't forget to subscribe.